Systemic crises do not arrive randomly. They arrive when pressure has been building for so long that the system loses its ability to absorb shocks. By the time something visibly breaks, the outcome is already locked in. Right now, the global financial system is showing that kind of pressure. This is not about predicting a specific crash or forecasting a date on the calendar. It's about recognizing when the structure holding everything together has weakened enough that normal events can trigger abnormal outcomes. There are only a handful of signals that reliably reveal this condition. Not signals that move every day, but signals that only activate when risk is no longer contained. When those signals align, history shows that disruption follows. They are aligned now. A true black swan is not defined by surprise alone. It is defined by fragility. The event itself is often mundane. What makes it catastrophic is the environment in which it occurs. Before major crises, markets do not collapse. They function. Prices move. Confidence appears intact. Under the surface, however, behavior changes. Institutions stop taking risk. Liquidity becomes selective. Credit tightens quietly. That shift is what matters. The first structural warning comes from interest rate expectations over time. When short-term borrowing costs remain higher than long-term rates for extended periods, it signals deep economic imbalance. Markets are effectively saying that near-term conditions are unsustainable. Short disruptions can produce brief distortions. Prolonged distortions indicate systemic strain. Extended periods where capital demands safety over growth reveal that investors expect difficulty ahead, not recovery. Historically, the most severe economic downturns followed prolonged periods of this imbalance resolving, not beginning. That transition phase is where instability emerges. The second warning comes from how credit risk is repriced. In stable systems, lenders demand compensation gradually as conditions change. When systems become fragile, that repricing accelerates. Risk premiums widen faster. Lending becomes more cautious. Financing costs rise not because of policy changes, but because trust erodes. This acceleration signals that participants are no longer comfortable assuming continuity. They are preparing for disruption. Credit markets are not speculative by nature. They are conservative. When they move rapidly, it reflects fear, not opportunity. The third warning is liquidity strain within the banking system. This does not appear first as failures. It appears as increased reliance on backstop facilities, emergency funding tools, and balance sheet adjustments. Banks do not borrow from safety nets during healthy conditions. They do so when funding mismatches emerge and losses cannot be realized openly. When multiple liquidity measures tighten at once, it indicates pressure that has not yet surfaced publicly. Individually, each of these conditions suggests elevated risk. Together, they indicate a system that has lost resilience. In past cycles, this convergence preceded major financial disruption every time it appeared. The form differed. The severity did not. The lesson is simple. Systems fail not because of one shock, but because they become incapable of absorbing shocks. Once that point is reached, the trigger becomes secondary. A bank failure can cascade. A bond market disruption can spiral. A geopolitical event can freeze credit overnight. A derivative exposure can ripple across balance sheets. The outcome is not dictated by the event, but by the fragility already in place. This environment has direct consequences for asset behavior. Most financial assets rely on confidence and liquidity. When either falters, those assets struggle. Hard assets behave differently, especially those tied to real-world necessity. Silver occupies a unique position in this context. It is not purely monetary, and it is not purely industrial. It exists at the intersection of both. That gives it asymmetric behavior during periods of stress. Historically, silver does not lead during calm expansions. It leads during systemic stress, particularly after intervention begins. The sequence is consistent. First, liquidity evaporates. Second, leverage unwinds. Third, authorities intervene. Fourth, currency dilution accelerates. Fifth, tangible assets reprice sharply. Silver responds most strongly in the later stages of that process. What changes from cycle to cycle is the magnitude. Today's environment is structurally different from previous crises. Debt levels are significantly higher. Policy flexibility is reduced. Supply chains are tighter. Inventories are leaner. Silver supply cannot expand quickly. Much of its production is secondary, tied to other metals. When demand rises suddenly, supply lags. At the same time, financial market structure has grown more fragile. Paper claims dominate pricing, but physical delivery remains the ultimate constraint. During stress, that mismatch becomes visible. Premiums rise. Availability shrinks. Settlement conditions change. These factors amplify price movement once demand shifts decisively. Another difference is awareness. Participants are no longer discovering silver's crisis behavior for the first time. Information spreads faster. Positioning changes earlier. This compresses the cycle. None of this implies smooth upward movement. Volatility is unavoidable. Sharp pullbacks are part of the process. Those pullbacks are what remove weak positioning and transfer ownership to stronger hands. This is where preparation becomes decisive. Preparation is not about prediction. It is about structure. Structure determines whether volatility forces you to act against your interests or allows you to remain patient while conditions unfold. Most people who failed during crises were not wrong. They were unprepared. They overused leverage. They relied on paper exposure without understanding counterparty risk. They committed all capital without flexibility. They assumed stability would persist until it didn't. Black swan environments punish those assumptions. Prepared participants think differently. They prioritize control over convenience. They understand liquidity is valuable. They align exposure with time horizon. They also understand that initial chaos does not invalidate long-term outcomes. Silver's role in this environment is not speculative. It is structural. It reflects how markets respond when trust in financial architecture weakens and policy intervention expands. The indicators are not predicting collapse tomorrow. They are signaling vulnerability today. That distinction matters. When systems reach this stage, the most dangerous assumption people make is believing they will have time to react. History shows the opposite. Once confidence breaks, adjustment happens faster than expected, and access disappears before prices fully reflect reality. This is why preparation always precedes opportunity. When liquidity stress becomes visible, institutions do not wait for clarity. They move to protect themselves. Lending standards tighten. Risk exposure shrinks. Balance sheets are defended aggressively. These actions reinforce stress elsewhere in the system. Credit contraction is rarely announced. It is felt. Businesses struggle to refinance. Consumers face higher borrowing costs. Asset values adjust downward as funding becomes scarce. This is where policy intervention becomes unavoidable. Authorities respond not because they want to stimulate growth, but because they need to prevent collapse. Stability becomes the priority. The tools are familiar: emergency lending, rate cuts, expanded guarantees, balance sheet expansion. These measures work in the short term. They stop the bleeding, but they also dilute the value of currency over time. That trade-off defines every modern crisis response. When liquidity floods the system, it does not distribute evenly. It concentrates in assets perceived as stores of value. Hard assets respond not because they are rising in real terms, but because the unit measuring them is weakening. Silver benefits from this environment because it cannot be manufactured by policy decision and because it remains essential to real economic activity. During the early phase of crisis, silver can behave counterintuitively. Forced selling, margin calls, and liquidity shortages can push prices lower temporarily. This phase shakes out leveraged participants and creates the illusion that silver has failed. That illusion never lasts. Once intervention scales, the conditions that suppress silver reverse. Real yields compress. Currency supply expands. Confidence in paper claims weakens. Demand for tangible assets increases rapidly. This is when silver historically transitions from weakness to strength. The scale of that transition depends on starting conditions. Today's conditions are more extreme than in prior cycles. Debt burdens are higher. Policy constraints are tighter. Supply buffers are thinner. Financial market structure is more complex and interconnected. Silver inventories are already constrained. Production growth is limited by long development timelines. Recycling and secondary supply cannot ramp quickly enough to offset demand surges. At the same time, the paper market carries more leverage than in past cycles. Futures, derivatives, and synthetic exposure dominate price discovery. Under stress, These mechanisms strain. When delivery becomes uncertain, confidence shifts to physical ownership. Premiums expand, access tightens, price signals lose relevance. These dynamics create asymmetric outcomes. Downside becomes limited by intervention. Upside becomes driven by scarcity and demand. This does not remove volatility. It concentrates it. Volatility is not the enemy in these environments. Forced liquidation is. Those who are forced to sell during stress transfer value to those who prepared. Preparation means maintaining control. Control over ownership. Control over liquidity. Control over time horizon. Participants who rely entirely on paper exposure face counterparty risk they cannot manage. Participants who deploy all capital lose flexibility when opportunities emerge. Participants who depend on leverage lose autonomy when rules change. Crisis environments reward autonomy. This extends beyond markets. Systemic stress affects access to capital, banking services, and normal financial operations. People who prepared in advance preserve optionality when others face restrictions. This is why preparation is not pessimism. It is realism. Some will argue that warning about black swans is pointless because they are unpredictable by definition. That misunderstands the point. The goal is not to predict the event. The goal is to recognize when the system is vulnerable enough that an event matters. That vulnerability exists now. Extended rate distortions have resolved. Credit risk is repricing rapidly. Bank liquidity stress is elevated beneath the surface. These conditions have not aligned without consequence in modern financial history. The exact trigger will surprise everyone. The outcome will not. Silver's historical behavior during such periods is consistent because the forces driving it are consistent. Confidence breaks. Liquidity expands. Currency weakens. Tangible assets reprice. What differs each time is magnitude. This cycle has the potential to exceed previous responses because starting conditions are more extreme. That does not guarantee linear gains. It guarantees instability. Instability favors those who prepared. Preparation does not require certainty. It requires humility. The humility to accept that systems can fail. The humility to structure exposure accordingly. The humility to value control over convenience. Most people will ignore these signals until stress becomes visible. By then, choices narrow. Those who act earlier preserve choice. The indicators are not opinions. They are measurements. They reflect behavior across markets that are typically conservative and slow to react. When those markets move decisively, it signals a shift that deserves attention. We are in that shift. The system is not collapsing today. It is becoming less resilient. That distinction matters. Reduced resilience means shocks propagate instead of dissipating. Silver's role in this environment is not speculative hype. It is a reflection of how markets adapt when trust weakens and policy expands. The question is not whether disruption occurs. The historical record suggests it will. The question is whether you will be reacting after conditions change or positioned before they do. History consistently favors those who recognized structural signals early and acted deliberately. Those signals are present now. Stay disciplined. Stay prepared. And don't wait for confirmation that only arrives after opportunity disappears.